Hello, UOB KN clients and friends. Today I want to make a few observations about what markets are doing right now. The U.S. equity market has actually been quite measured given events in the Persian Gulf and the implication those events are having around the world. But more traditional safe havens like treasuries and precious metals have seen more meaningful moves. The S&P 500 is not far from its all-time high. The peak closing level was 69.78 in late January. Right now, S&P futures are implying a level of about 66.59. That's a decline of roughly 320 points, or about 4.5% from the peak. The U.S. equity market has been surprisingly resilient. S&P 500 futures are up about 0.8% from Tuesday's settlement price. After the close of U.S. markets on Tuesday, there were more positive headlines about discussions about potential negotiations between the U.S. and Iran. 0.8% is not particularly a big move, but it's hard to say that the headlines justify equity markets going up more dramatically. Although Trump is playing what's going on to be more than just talks about having talks, there's a long distance between that and actual negotiations. So the situation remains uncertain. As I said earlier, we're only about 4.5% off the highs. If markets had fallen much more, you would expect a stronger bounce on good news. But when markets are already near the highs, there's less room and less urgency for a sharp rally. On Tuesday, the 2-year Treasury yield jumped after a weak auction, rising roughly 7 to 9 basis points to about 3.9%. That's close to the 4% level, a level we haven't seen in about 10 months. In Asian trading today, yields have come down a little bit following Trump's comments about potential talks. Rates are still elevated, and that creates a headwind for equities trying to move higher. Some investors, like DoubleLine's Jeffrey Gundlach, argue that the 2-year doesn't just reflect Fed policy, it actually leads it. So when the 2-year yield jumps, like it did this week, towards 4%, markets indicate one rate cut is still possible this year. So if U.S. equities are going to move higher, they may have to do so in the face of higher yields than investors expected at the start of the year. Since the conflict in the Gulf began, the U.S. dollar has been strengthening. If rate cuts are less likely or more limited, the dollar becomes more attractive. The U.S. is now a net exporter of energy. So while higher energy prices are not positive, they tend to hurt other economies more than the U.S. And that relative strength supports the U.S. dollar. That stronger U.S. dollar helps explain what we've seen in gold. Gold is the ultimate anti-dollar trade. So a strengthening greenback is a negative for the gold price. Gold had been moving sharply higher earlier this year. A lot of hot money had been piling into precious metals. But when the dollar strengthened and rate expectations shifted, that triggered profit taking. So we got somewhat of an unexpected outcome. And that dynamic is continuing right now, with rising hopes for talks between the U.S. and Iran, which imply potentially less geopolitical risk. Gold is rebounding. But with gold, I think we can be cautious in our conclusion. It is difficult to say that it has formed a base and is going to return to a bullish trend.